It is 28 minutes past 3 in the afternoon, still on Wednesday, the 27th of May. We are recording this one day ahead of time, as we are recording this with Eoin Treacy, who is out in the US. And as a result, the time zone differences make this a little harder to do on the actual day. But anyway, in today's broadcast, we'll be dwelling on a theme that we actually started discussing yesterday with Tim Price, which is on the sort of the reaction and overreaction when it comes to lockdowns and some of the economic effects of that over the longer term. Now, Eoin, thank you very much for joining me on today's market broadcast. Could you explain some of the correlations that you've been seeing with the Millennium bug and the coronavirus way back, in the very early 2000s, the dawn of the Millennium, where everyone was afraid of how the Millennium bug would destroy an awful lot of the digital infrastructure?
Well, I think if there was a mild comparison, probably last week, it's become extremely strong this week. Back in 1999, there was a massive boom going on in the technology, media, and telecom sectors, the TMT bubble. And then we had the Y2K come along. People were terrified that their technology was going to stop working, that because they didn't believe that when dates were put into computers, anyone thought that there would be, in fact, a 2 in the front number instead of a 1 for 19s, then it was a real problem. And it pulled forward a huge amount of spending into 1999 for every form of new technology, because everything had to be upgraded. Well, in the end, Y2K turned out to be a storm in a teacup. And then we got into 2000, and everyone had spent an enormous amount of money on new technology. There were no new sales, and all of the spending had to be paid for. And the NASDAQ went into a 3-year bear market. Now, that was, of course, I think, the problem in 9/11 in 2001 obviously further exaggerated the bear market. But the reality was that although the problem itself, which was Y2K, turned out to be almost a non-event and was looked back on rather sheepishly by people and investors, the reality was that it resulted in an enormous amount of spending. Now, we have to compare that to what's going on today, because one of the reasons why the lockdowns were put into effect was because state-run health organizations believed that the mortality rate was anywhere from 3 to 4%. But the CDC announced yesterday that their updated mortality rate is 0.4%. So they've downgraded the mortality of the coronavirus by 90%. And therefore, that brings back onto the table the question of whether the coronavirus really is just a bad flu. Then there was also data came out yesterday in Italy that something in the order of 96% of people who died had a comorbidity. But the average age of the people who died was 80 years old. And large numbers of the people who die are in nursing homes. Now, it's worth remembering that a nursing home is not a retirement community. It's generally where people end up because the illness that they're dealing with is too bad to go home or too difficult for their families to help look after them, but not bad enough to stay in hospital. So nursing homes is where they end up. And therefore, nursing homes are filled with people with compromised immune systems and weakened bodies generally. So the coronavirus has ripped through those facilities, and half of all deaths have been from nursing homes. Of course, part of the reason why it's got into nursing homes is because a number of countries and states in the USA housed coronavirus patients in nursing homes at the beginning of the crisis. So they, in fact, introduced it into nursing homes and greatly exaggerated the number of deaths. That's something that's not being reported on. Now, if the official data is 0.4% for mortality and half the people dying are in nursing homes, the chances are that the real mortality rate is probably 0.2, and that's only twice as bad as a normal flu. So that is very similar to what we've had with Y2K, because the people in 1999 believed the world was going to end. And today we have people talking constantly about how the world is going to be different going forward. What is going to happen in terms of our lives? Are we going to be wearing masks forever? Are we going to be dealing with the coronavirus forever? But the reality is that if it is really only a bad flu, then lockdowns are unnecessary. We certainly need to pay attention to gathering in large numbers in confined spaces, because that is certainly going to spread it. But we are past the worst of it. And now the big question is that how are we going to pay for the lockdowns? Because I've looked at, or I compile indices of central bank balance sheet assets, and they have gone from under 20 trillion to more than 24 trillion in 3 months. So $4 trillion has been printed globally by central banks. Then I also have custom indices tracking the budget deficits of a large number of the big economies in the world. And that is currently sitting at $1.6 trillion in deficit. So altogether, we're looking at a spend of about $5.6 trillion to try and mitigate the impact of the lockdowns, which it's turning out were probably unnecessary at worst, and at best have already gone on too long. And that's a challenge, because all of that money that's been borrowed is going to represent a very significant halter on the necks of consumers going forward. It's going to mean there's going to be higher taxes. It's going to mean that there are going to be some significant challenges in trying to figure out how all this is going to be paid for.
There's a lot of threads that we could pull on there. Though I remember earlier on this year, I'd been thinking a bit about the Millennium bug as well, and I remember finding an old newspaper article about how in the few months leading up to 1999, how the Federal Reserve had begun expanding its balance sheet in order to try and offset some of the trouble that was anticipated as a result of the fears from the Millennium bug. This idea that by printing money, somehow that this was going to help. Whatever it was that was going to happen, printing money is going to help, and that really helped juice the stock market in the final run up with the 1999 dot-com boom. There are plenty of comparisons we can draw today with central banks similarly expanding their balance sheets, sort of presenting themselves as the solution to the coronavirus, and trying to make liquidity as abundant and available as possible for whoever needs to use it as a result of all of this. Interestingly, though, the expansion of the balance sheet in this way, in February, it was definitely when we were already seeing an awful lot of intervention from the Fed in the repo market. In February, there was still a lot of juice in the stock market. Going forward from this, when you're talking about the amount that will have to be paid, and the manner in which it will be paid, do you think taxation and higher taxation is something that's going to be really politically palatable going forward for all of these developed countries? Considering the amount of chaos, the amount of blame that's being thrown at governments already based on their handling of the crisis?
I think it's going to be an incredible challenge. And I would also like to come back to your point about liquidity, because one of the challenges are the factors that contributed to the crash in the Nasdaq was raising interest rates in early 2000. That the Fed really did get worried about the pace of the rise in the stock market, and they did intervene to try and arrest the decline. And there's practically no chance of that right now in the US. So I'm not necessarily predicting there's going to be a crash, but rather that we have got to figure out about how to pay for this. And this is going to be a challenge because the vast majority of people are sick to death of austerity. They're not going to stand for it. And that means that taxes are going to have to be imposed where they're not visible. So the two that really stand out to me are the first, that there's going to be a lot more green taxes, so that because everyone would support the or climate measures and trying to alter the economy to clean the environment, and let's hold on to the blue skies that we had when everybody wasn't driving around. So we're probably going to have a lot more green taxes. And then we're probably going to have to start to see taxes on second homes, taxes on wealth. So there will probably be wealth taxes as part of it as well, because it's a crowd pleaser. You got to remember that Boris Johnson won the election by appealing to Labour voters. And if he wants to hold on to those voters, he's going to have to deliver something that soaks the rich. And that does suggest that there are going to be wealth taxes in the form of higher property taxes or just outright taxes on the wealthy.
Yeah, the concept of blue sky measures. You know, there has been so much celebration with, you know, nature is healing comments all over the place, with, you know, the various ways in which habitats and the manner in which so wildlife has returned to the cities is being celebrated to a large degree. I can imagine there being a very popular campaign with trying to retain some of this rewilding that we've had so far. From an investment standpoint, looking forward, we've dwelled a bit on the amount of stimulus that was injected. My colleague Charlie Morris, our colleague Charlie Morris, I should say, commented to me the other day that, you know, if you take that global picture, you said $1.6 trillion of effectively new demand that was brought forward, you know, new money that was created in order to try and solve the virus to some degree. It was equated to, he equated it to effectively an entire USA, you know, the world's largest economy, just getting thrown into the world again, like an entirely new one just being created out of thin air and then just thrown into the global economy. And the manner in which that will change asset prices and change the market could be quite remarkable, quite extraordinary. The manner in which they will move. What do you think this means? I mean, is this like do you think this is an inflationary move? The idea of central banks not raising interest rates, as you've already said, austerity not being popular, so more government spending, and higher taxes affecting only the rich, not the people who really affect consumer spending so much in society. I mean, that all comes together as a pretty inflationary picture. Am I reading that right?
Well, to have inflation, you need to have economic activity picking up. There has to be a rise in the velocity of money. And the velocity of money has been on the floor because nobody has been out spending.
Right.
So the challenge of inflation is a medium-term challenge. And what we're being presented with in the short term is deflation. But I do agree that inflation is on the horizon. Now, it's also worth reminding ourselves that we're in a very interesting condition today in the global market, which is similar except reversed in relation to the yield that you have on equities and the yield you have on bonds. Because back in the 1930s, it was quite normal for equities to yield more than bonds because companies were deemed to be more risky, and investors demanded that they have an additional yield return from companies before buying the stocks relative to the security of treasury bonds. Whereas today, we are now back at a similar yield differential, with equities yielding substantially more than government bonds, except for the fact that it is today the companies are the real credit-worthy entities, and it is governments are stony broke. And if it wasn't for the actions of central banks to go in and literally depress borrowing costs to aid their respective governments, we would have much higher interest rates. So this is, I think, one of the big questions. It's whether we're going to, in fact, have inflation, or are we going to have another very slow and low growth path coming out of this contraction, and not least because interest rates are being held down and because central banks are manipulating the yield curve. In fact, are we moving much more into a Japan-like scenario?
Let's wind back slightly to your original comparison with the Millennium bug and the Wu flu, because you mentioned how in the aftermath of Y2K, there was that 3-year bear market, which you'd attribute to the amount of spending that was brought forward in anticipation of it and needing to be paid back in the years following it. Do you think that similar sort of bear market that followed it for 3 years, do you think that fits this current scenario?
I think it fits this scenario certainly for companies that have been hit hardest by the coronavirus, and then also particularly for the companies that have done best from it. Like if you think about companies like the delivery companies or the cloud companies, they've had sales pulled forward into the current year that probably would have taken 2 or 3 years. Any company that is still in business today that hasn't invested some infrastructure in cloud is probably not going to be in business for very long. Well, what that at least tells me is that some of that business has been pulled in already. And where is their new growth going to come from? And particularly, where is growth going to come from that is nearly as strong as what they've just seen? So valuations have increased substantially in the cloud sector. And I think we're probably in for a pretty prolonged period of underperformance for the sectors that did best during the lockdowns.
That's quite interesting. So it's almost like the future success has been brought forward for cloud computing companies, and I suppose there's that again. That's a similar comparison with that early 2000s period where, and the late 90s dream of how the internet was going to change the world, and how we had to wait until the late 2000s and the early 2010s before that really started materializing. Do you think that's similar to effectively all of those businesses that have just made a real success out of this with their cloud computing? Do you think all of the profits that they're making now they will make in the future, but and they're on a regular basis, but they need to there's going to be a few years before the dream is really realized?
Well, I think the product is reasonably mature, but and the cloud's not going anywhere. Every business is going to have a cloud strategy going forward. It just simply makes sense because it's cheaper. But I think I would agree with what you said in that so much of their sales have been pulled forward that we are going to have cloud. We're going to have a lot of services delivered over it. But that does not mean that the shares have to go up in a straight line.
Yeah, quite. On that Japan comparison, are you meaning a comparison? So, with Japan's lost decades following 1989, most investors are very familiar with the story. We do see there are plenty of people who call for Japan to be the prototype, the forerunner for what the developed world is going to see in the future. Do you think when you talk about how we may be seeing a repeat of the Japan scenario, are you meaning that is that region specific, right? So do you think that's how it might play out in the Eurozone, or do you think this is how it might play out in the US, or Australia, Canada, or are you meaning this simply more broadly, where there's going to be a large a period of time where very little is really going to happen apart from the government bond market keeps ticking over and becomes ever more zombified by the central bank. Growth is there, but it's not very, very much. And, the deflation threat is constantly there. Could you expand on that a bit?
Well, we just have to remember that we were already late in the cycle last year. And then we had the coronavirus and the lockdowns and all the panic, and that didn't change the fact that we're late in the cycle. And the expansion, the economic expansion that started in late 2008 and early 2009 up until this year was one of the slowest in history. Usually after a big decline, you get a big resurgence in demand and activity, and economic growth picks up and surges ahead. That did not happen after 2008. And the pace of growth was significantly slower than other recoveries. And now we've had one of the biggest declines in history in terms of economic growth. Now the question is going to be, are we going to get a normal recovery where growth surges back on the upside, or is growth now going to be another very low par event, so that when we do return to growth, the low interest rate environment is going to, in fact, inhibit the growth capacity of the economies? That's true of the USA, but particularly of Europe, because they have got demographics that are significantly worse than anywhere else in the world except Japan. So Europe is probably going to have another low growth recovery, and the USA will also have another low growth recovery without some extremely powerful animating factor.
Considering how Japan has survived Japanification, as we refer to it now, and the economy has adapted entirely to this this phenomenon that everybody looks at from the outside, that seeing how strange it is and wondering if it's going to come to their own country. Considering just how Japan has still managed to prosper to a large degree. I mean, it still functions very well as an economy. It still has a very cogent, a very very well developed society. It has everything that you would expect really of a developed economy, apart from very, very strong, strong growth really, and apart from a very strong inflationary force, or at least a constant inflationary force. Considering that, do you think in this environment where we are looking at Japanification extending to other developed nations, do you think Japan is actually a place where, well, people should be thinking of investing in? Because all these companies have gotten used to Japanification, right? They're at home in this kind of environment. I remember a colleague of mine, a fund manager, remarked how there was one company that they had in their that they were investing heavily in, that had, I think it was 17 years. They could go 17 years without making a profit. And they would survive completely well, because they've gotten used to this deflationary environment where interest rates are zero, and costs are constantly being threatened at actually going down. Profits going down, input costs going down, and the consumer having less money to spend is something that they've actually gotten used to. And as a result, these companies are incredibly resilient at this time. Do you think Japan is maybe the place to put money to work?
I think Japan is as is an interesting place from the perspective that the economy has been doing better, and they were at full employment, and they are slowly but surely starting to modernize. So there is certainly that. It's not going to go up on its own. One of the reasons why Japan has been able to get through this decades-long process of deflation is because exports held up, and they've always had a positive current account. So while the domestic economy went through a very painful rationalization, exports were doing fine. And also, even though interest rates were close to zero for a prolonged period domestically, international interest rates were substantially higher. So you had a very significant movement of capital out of Japan and into higher yielding assets elsewhere.
Right.
So that's not really possible today. For countries that are looking at a deflationary outcome, or are looking at very low growth and looking for where to invest for a better return, well, you just don't have the pickup in yield by going abroad. Japan was able to go to Europe, it was able to go to the USA or Australia or New Zealand to pick up that extra yield. Well, now interest rates everywhere have compressed. So the question then is, where can an investor go to pick up that extra yield? Well, the answer over the last 5 or 6 years has been the technology sector and private equity, where you could pick up a substantial yield. But of course, that is much riskier. And that's the challenge, that we are moving progressively further towards a low interest rate environment for the whole world. And then that is forcing investors into speculative activity. That is the kind of thing that will eventually create a bubble, or it will eventually crash the 40-year bull market trend in government debt. So we're not just late in the cycle in terms of the move up from 2008 and 9, but there are big machinations happening in the background that also we need to be aware of.
Very interesting as always, Eoin. Before we do finish up for today, then could you give our listeners maybe a bit of a hint as to where you think this perhaps a sector which you think is going to do very well out of this, other than simply tech, for example, or private equity? Is there any hints that you could give as to one of the an investment that might thrive in this kind of all close to Japanification environment?
Well, gold is a really easy answer.
Yeah.
I mean, I could tell you hotels. I mean, if this is Y2K, then nobody wants to go to a hotel today. If people stop worrying about the coronavirus, then hotels are going to do well because they're really cheap right now. But gold is really cheap right now, even though it has gone up significantly over the course of the last year. Gold shares are still lagging the price of gold. This is classic early stage bull market activity. The reality is that if central banks the world over are really flogging the value of their currencies, then gold is the only barometer against which you can measure your purchasing power. And gold is rising in every currency. So that is clearly a bull market phenomenon. And I'd like to look at markets from a simple perspective, that after a big decline, you look for the sectors that do best. And gold has been breaking on the upside, and none of the sales from the future have been pulled into the present. So I think it's going to be a buy on the dips for the foreseeable future.
That was Eoin Treacy over at Frontier Tech Investor. Thank you very much for joining me, Eoin.
Always a pleasure.
That's all for today's market broadcast. Of course, as with all of these market broadcasts, we are not in the business of giving investment advice across them. This is simply to discuss our opinions and possible views as to where the market may go. Always do your own research before deciding to add, a significant amount of your capital into any particular investment. But that sums up today's broadcast. I shall be back again tomorrow. Tomorrow's I shall have Akil Patel on. He's something of a favorite when it comes to these, and he wrote a very interesting piece recently for his subscribers. I'd like him to share a little bit with you. And it's all about how the great property cycle, or the land cycle, as he describes it, is something that actually, in a way, creates wars, and how wars are always being fought to some degree over land as a whole. But that is all for today. I shall be back again tomorrow. Do give me a follow if you're interested on Twitter. I'm at Federal Excess, and I shall be back again tomorrow.